All right. So in this session, we will do the question number one from September, December 2021, and we will look at the first two requirements, requirement A and B. So in this first screen, as you can see, it's just an intro of the question. It is 1st July 2005. You are manager in the audit department of McLean and Co. I'm of firm of chartered certified accountants. You are assigned to the audit of Gruber Company, which has a financial year ending 30th September X5. Gruber Company has a new audit line of McLean and Co. The audit firm having been appropriate in January X5. The audit was previously performed by Elise Associates. Gruber Company is owned and managed by the Gruber family. Its principal operations being the design and construction of bespoke machinery used in the oil industry. The following exhibits are available on the left hand side of the screen. Provide information relevant to the screen, left or right side. Uh, it's a partner's email. Number one, email you have received from the L Powell, the audit engagement partner, business and governance. Information matters relevant to the planning, financial information, extract from Gruber's company, Mostman, recent management accounts. Number four, business developments, information relating to the investment property and customer contracts. And number five, meeting extracts, extract from meeting notes taken at a recent meeting with the board of directors of Gruber Company. So, requirements straight away. Let us move to the email part. Okay. Um, to audit manager from audit partner, audit planning from Gruber Company is the subject. 1st July 5. I've provided you with some information which you should use to help you planning to the audit of Gruber Company for the financial year ending 30th September X5. As you know, Gruber Company is a new client and the firm client due diligence and acceptance procedures were successfully completed. I require you to prepare the note for my own use. Okay, so first requirement, discuss the matters specific to the planning of initial audit engagement part. Engagement which should be considered in developing the audit strategy. 6 marks available for it. Using the information in 1, 2, 3, and 4 exhibits, evaluate the significant audit risk to be considered in planning the audit. 24 marks available. Uh, design the principal audit process to be performed in respect of the Nicotomy building, including those relating to the use of an expert to provide the fair value, and discuss the ethical issues raised and recommend actions to be taken by a firm. 8 marks. Okay. So, to audit partner from audit manager, subject Gruber audit planning, date 1st July 5, and then these brief in introduction, what you'll say in this briefing notes includes copy paste specific matters relating to the planning of initial audit engagement, okay, which should be considered, comma, evaluation of the significant audit risk, comma, um, principal audit procedures to be performed in respect of the Nakotomi building. Finally, the ethical issues and recommendations for the firm. See what I've wrote. Uh, Here. These briefing notes include discussion and implication of the audit engagement, evaluation of audit risk, also recommendation of audit procedures to be performed in relation to the investment property or economy building. Finally, the notes address the ethical issues arising from meeting with the company management team. Simple and easy. Okay. Uh, Initial audit engagement. First requirement, 6 marks, knowledge base, very simple. Number one, in initial audit engagement, there are several factors which should be considered in addition to planning procedures which should be carried out. First issue, ISA 300 suggests that unless prohibited by law or regulation, arrangement should be made with predecessor auditor, for example, reviewing the working papers. Two, three. Um, Therefore, communication should be made with the LA's associate to request access to the working papers for the financial year ended 30th September X4. Mm, The review of previous year working papers would help McLean and Co. in planning the audit, for example, uh, um, as it may highlight matters pertinent to the audit of opening balances or an assessment of appropriateness of Gruber Company accounting policies as good on client acceptance procedures, professional clearance was obtained should be considered for the potential impact on audit strategy. They should also be consideration matters should be discussed with Gruber Company management in connection with the appointment of Macklin and Co. as auditor. The team should also consider major issues which have been discussed with management and initial meetings and how the matters impact on overall audit strategy. So do not write in pointers. This is just the planning points. Use these in small paragraph, and you're ready to get 6 marks. Simple. Now, next requirement, which was using the information in exhibit 1, 2, 3, and 4. Remember, not four, fifth exhibit, only four exhibit. First four exhibits are relevant. Evaluation of the significant audit is to be considered in planning the company audit. 24 marks available. Firstly, let me tell you the exam technique. That is MTRC. Materiality, treatment, risk, conclusion. 4 marks maximum are available. If you're getting first compute materiality, explain the treatment, the accounting treatment, what are the risks due to them, and your conclusion. You'll get 4 marks. If there is only materiality, treatment, risk, 3 marks. If there is only materiality and treatment, 2 marks. If there is treatment and risk, 2 marks. Vice versa. Okay. So, firstly, we do not need to go to the scenario immediately because we already identified our first issue, that is new audit line. So first year in which Maclean has audited the company, which increases detection risk. So there is also a risk that opening balances and comparative information is not correct. Their risk can be mitigated through rigorous audit planning and by reviewing working papers after getting from Elise Associates. Okay. Uh, Now, 2 marks for that. For further, let us go to the scenario. The company was established 15 years ago by Martin Gruper, an engineer who has patented a new types of machine used in the oil industry. Martin, who is in the company's chief executive officer, owns 16% of the shares in the company, with the remainder split equally between his brother and sister Craig and Aris Gruber. The company board of directors includes Craig Gruber as a CFO, Aries Gruber as marketing director, and a non-family member, Cale Hayes, who is director of operations. Gruber Company has 300 employees, most of whom are mechanical engineers. Martin is planning to sell his shares and retire from the business. Craig and Aries, who are younger than Martin, will retain their shares and their board positions. Initial discussion with the potential acquirer for Martin shares began last month. We get another point. Let us jump to it. Uh, Here it is. Management buys. The company major shareholder Martin Gruber planning to sell his shares and in company, and initial discussions who have already taken place with a potential purchaser. This situation means that there is a risk of management bias in that Martin will want to maximize sale price, and for this reason there is a risk that assets will be overstated and revenue and profitability maximized. 2 marks for that. Total 4 marks till now. Now move on uh, to the other part. Now The company owns a head office and leases a production facility where machines are designed and assessed under contract with individual customers. Typically, an order takes 14 months to complete from the initial design through to installation at the customer's premises. This is due to the large size of the machinery being produced to customer and order and the very specific requirements of customers. Okay. Moving on, we have some key informations. Management accounts, revenue 75 million projected, 65 million last year, 40, 18 and 10, 120 and 88. Total assets included in total assets are the intangible assets 19 and 10. Now, revenues derived from contracts involving the design, manufacture, and installment of machinery to customer order. Currently, the company establish all of its customers' contracts to contain only one performance obligation, the successful installation of the machine at the customer premises. However, around a quarter of contracts also include 3 year support service for the machinery installed. Note one. Okay, now we got it. So moving up to the here it is, recognition of revenue support service. So see what I say over here. The company sells around one quarter of its machine under a contract which include support service, but all contracts are currently established with only one performance obligation. Okay. uh, IFRS 15 requires that when accounting for revenue, the performance obligations in the contract are identified and whose contract has performance obligation. Revenue should be allocated to the performance obligation in the contract by performance reference to their relative share standalone selling price. There is an audit risk that Gruber company is not disaggregating the contract revenue between the obligation relating to the supply and installation of machine and provision of support service. This could result in revenue being overstated if revenue relating to support service recognized at time of part of revenue. So far, so good. Combine those points into the small paragraphs, and here we go. We got 3 marks. So overall, 7 marks till now. Now, moving to the scenario, we have some more points relating to the revenue contracts. Here it is, Argyle contract. In 2004, Kruber company entered into a significant contract, okay, to design, construct, and install a large piece of machinery for a new customer, Argyle company, in October Expo. It was determined that the design and construction of the machine would take 15 months, with installation estimated to take place in January X6. The agreed price of the machine is 6 million, and Gruber company will have incurred of 2.6 million in relation to the contract by 30th September X5. Uh, Based on the project plans, the estimated value of the work certified at 30th September X5 is 4 million, and the estimated cost to complete is 1.2 million as noted in Exhibit 3. Operating profit before produces a profit of 2.2 million relating to the Argyle contract. Okay, jump to the relevant part over here. Here it is. Uh, Recognition of revenue profit Argyle contract. The CFO suggestion that the full amount of profit can be recognized this year in respect of this contract is incorrect. When performing long-term contract, IFRS 15 states that, okay, IFRS 15 states that appropriate method of measuring progress towards the satisfaction of performance obligation. The completion of the contract include output method and the stage of completion of performance obligation by reference to the value to the customer of the goods or service transferred to the remaining goods or services promised under the contract. The revenue should be allocated to the performance obligation in the contract by reference to their relative standalone selling price. There is an audit risk there that Gruber Company is not disaggregating the contract revenue between the obligation relating to the supply and installation of machine and provision of support service. This could result in revenue being overstated and revenue relating to support service recognized at time by part of revenue based on stated accounting policy, which is to the output method. The stage of completion should be based on work certified, which is uh, projected to be 4 million compared with the contract price of 6 million, giving a percentage completion of 66.7%. The company should therefore recognize 66.7% of estimated 2.2 million profit on the contract, which is 1.4 million. Profit is therefore overstated by 730,000. This is material. 5.2% of profit before tax accounting treatment could be indicator of management bias and uh, of Martin Gruber to overstate profit for the year. So far, so good. Right. Just a second. Now, next part we have to look at Johnson contract on 1st of December 2004. Kruber Company entered into a contract with Johnson Company to design, construct, and install a machine. The contract, which will take 12 months to complete, was initially projected to make a profit of 2.8 million. However, due to cost inflation and errors which made in the initial project budget, the contract is estimated to make a loss of 840,000. By the way, the projected profit to 30th September X5, including a loss relating to the Johnson contract, it is correct. Loss should be recognized. However, material recognized method recognized to recognize loss over time is not appropriate. When contracts are expected to be loss making, they should be accounted for as onerous contract according to IS 37, which requires provision should be recognized for onerous contract. Okay, so now what is onerous contract? An onerous contract is a contract in which the unavoidable cost of meeting the obligation under the contract exceed the economic benefits expected to be received. Now, the treatment IS 37 states provision should be measured based on the unavoidable cost of the following contractual obligation. Then, from the information, we will connect to the scenario. From the information provided, it is not possibly to determine the exact amount which should be determined, but recognizing loss over time is not appropriate, and it is likely that the loss recognized and provision in SOFP are understated. So finally, this could be signal of management bias. The accounting treatment applied reduces loss recognized within profit for the year. That's how you need to do. Uh, Moving ahead, another para we have regarding the investment property. In October X4, following the completion of a significant contract, the company purchased an investment property, the Nicotemi building, for 15 million. The property is a retail development in the country's capital city. The company is going to appoint an expert to provide a valuation of the property, and an initial estimate of the increase in fair value of 2 million has been included in the company's financial projection to 30th September X5. Okay, moving ahead. Where is the relevant investment property? Here is the 15 million investment in academy building The 15 million invested in academy building is material represents 12.5% of total assets. The change in fair value, which is recognized in P&L, is also material at 14.3% of PBT, profit before tax. It is appropriate that property is measured at fair value and that gain is recognized within profit. According to IS 40, entities can choose between fair value model and cost model for measurement of investment properties. When the fair value model is used, gain or losses from rising from changes in fair value of investment properties must be included in P&L for the period in which it arises. 3 points for this part so far. An audit risk arises from the size of the fair value gain, which has been recognized. The properties was only purchased at the start of the financial year, and an increase in fair value of 13.3% in 12 months' time period is significant. So the valuation of the property yet to be performed. So the fair value currently included in financial statement could be attempt by management to boost profit for the year. Then we have something related to intangible asset as well. Look at the point 4 over here. Oh, sorry. Yeah, here in the exhibit 3. The change in fair value of intangible assets represents a transaction which took place uh, in March X5, where Gruber Company purchased some designs from Martin Gruber for 9 million. The value of this transaction was determined Martin Gruber. The audit engagement partner has asked for information to support this value, but nothing has yet been received from Martin. Okay. Whew. So far so good. 2 points basically. So far we have gained 15 marks and 16 marks actually. The intangible asset recognized in the year at the cost of the company of 9 million is material to SOFP as it represents 7.5% of total assets. It is also material by nature as it is transaction between majority shareholder, CEO and company, making it related party transaction. Okay. Uh, there is a risk of management bias relating to this transaction, given that Martin is planning to sell his shares. There is a risk that transaction is an attempt to window dress financial statement in order to maximize asset value, influence business valuation, and ultimately increase the amount which receive on selling his shares. So there is a risk that okay now uh, one more thing which we are getting from this para related party transaction. The sale of designed by Martin Gruber is related party transaction. Related party transaction, define it is a person who has control or joint control over the reporting entity. Therefore, Martin is a related party of Gruber company, and sale of his design is a related party transaction. So there is a risk that disclosure of transaction is not made in accordance with the IS 24, which requires that if share has been transaction between related parties. Then finally, we'll perform some analytical procedures, overstatement of revenue profit, analytical procedures for the financial statement shows something like that. Revenue is projected to increase by 15.4%. Operating profit projected to increase by 80%. PBT, profit before tax, projected to increase by 55.6%. And there may be relevant and appropriate explanation for you know, for the trends. The auditor should be alert to the possibility that revenue and profit could be deliberately overstated. The trend in operating profit is concerning. Management will need to provide explanation and corroboratory evidence in support of the projection in this case. So that's how you need to draft You can make these points for in your planning time like this, and then you convert them into small paragraphs, and there you go. You are ready to draft a perfect answer for your exams. By the way, audit risk is uh, in your upcoming examinations, where there are the 20 professional marks. You will The skill will be evaluated here is evaluation, and that's how you need to do it. I hope you get it. That's it. See you next time.